Yeah, Scott Bessent's 333. So he's got the new Treasury Secretary here. And kind of back
Newly
in June,
confirmed.
yeah, newly
Got a big new
confirmed,
plan.
back in June 2024. So at a conference in the Manhattan Institute called The Fallacy of Bidenomics, a return to central planning. He basically spent the time, you can actually just read all the remarks that they're posted online, just completely trashing, um, just completely railing against what the Biden administration had done.
Right.
But one of the things that came up in that's been in the news a little bit because people are sort of dissecting what this new Treasury Secretary has for plans for the U.S. economy. They're diving into this 333 idea that he put together. And those three things, they're 3% real growth by the end of Trump's tenure. So the deadline, I guess, is 2028. And the way in which for the 3% growth during this conference, he did go a little bit into depth, like a tiny bit. I'm talking like half a sentence, where he just listed out where that growth might come from. So he said deregulation, U.S. energy production. He said, quote, slaying inflation. And quote, let me read this one. Forward guidance on confidence for people to make investments so that private sector can take over from this bloated government spending. So with that
Interesting.
basically, yeah,
That was a mouthful, but I think that last one was actually
yeah.
a really good
So
point.
yeah, it's sort of a nod towards the understanding that government spending is going to come down, whether by, we've covered it on this podcast with Doge, generally just in my personal opinion, for the sake of the, the future of the U.S., it's like a national security issue we have to just bring down spending. But in order to fill that gap, because the government spending does contribute to, GDP numbers. What he's saying in that last point is that private investment is going to fill that gap.
Right.
So that's
And
the first three. Yeah.
yeah, just like with the idea that every dollar spent by the government is going to be less efficient, if you will, than private investment.
The other three, part of the 333, and it was apparently he's a big fan of Abe, so Japanese. And remember Japan, he had the three arrows, and
Yeah.
he just adopted it basically for his own set of threes.
Mm-hmm.
His second three is to get the deficit down to 3%. So that's going to be, as a percent of GDP, the deficit's going to be down to 3%.
Mm-hmm.
And then the last one is 3 million more barrels of oil produced every day. So those are the 333. And what I was looking at this and I sort of asked myself, like, I don't know, is this hard to reach? Is it easy? What's the context around these three different numbers? So that's what I wanted to share with you today.
Yeah, maybe like a little bit of context on. So if he wants to increase by 3 million barrels a day, then it's like, all right, well, what is it currently? If he wants to get to
Exactly.
3% growth, what is it currently?
Exactly. Is this hard? Like I did a little bit of digging into this. I kind of formed my own opinion as to, is this going to be hard? Is it going to be easy?
Mm-hmm.
Um, you know, but I'll not to lead the witness at all. So I'll keep it to myself, but see what you think at the end. I'll start with oil. This is the U.S. field production of crude oil in thousands of barrels per day. So we have 15,000. So that's 15 million. And he said he's going to increase it by 3 million per day. So basically bring this number where it is at now. Let's just call it 14 million and bring it up by 3. But like, if you look at this, just over the past 4 years, so under Biden, I was a little shocked to see that it's kind of already risen by, call it 3 or 4 million. It always took a plunge right after COVID, but it's come back.
So yeah, I mean, even compared to the past couple of decades, even back in the W years, drill baby drill, it doesn't look like that really helped too much. But yeah, I mean, last 10 years,
yeah,
very substantial.
Yeah, absolutely. So like kind of when I look at this, that we're going to increase it by another 3 million. To me, it's like, oh, we'll just grow by the same rate we've been growing. That's what it kind of sounds like.
Yeah,
It doesn't seem so crazy. It just kind of seems like, let's just keep it going.
Mm-hmm. Pare down some regulation and don't add any more regulation. And from that simplistic argument, it does seem pretty reasonable.
Yeah. So from the oil perspective, I mean, just kind of glancing at it, looks fine. It's fine. It's
check.
Fine. Check. Yeah, exactly. Like, does this pass the sanity check? Yeah, sure. So the next one is GDP growth. So we got on the left side, we got from the U.S. Bureau of Economic Analysis here, and we can see the last couple quarters. These are going to be annualized, so they should be. But we've got GDP over here in this orange, and you can see that it's kind of touching just this last quarter. It's already touching like 3%.
Yeah, Q3 was 3.1%
There you go.
actually, and then I guess just last bit of added context. Q4 just came out earlier today, and it was 2.3.
There you go. Okay, yeah, no, that's fantastic context. So like you look at his 3% growth target, and also sort of seems doable. The other thing that kind of this graph sort of points to that I think is also really important. It also shows as to where this growth is coming from. So you can see, relative private goods that grew sort of down here. So that was sort of a net drag on this 3.1 number. It looks like the amount of kind of government spending had also grown over the quarter, as it has been. But really what's driving it is the private
Biden's
services.
Last, hurrah.
His last push. I don't know.
No, I mean, but seriously, he did ramp up a lot of spending on his way out. Like, I know a material amount was done in Q4, but some of it probably occurred over Q3 as well.
Yep.
Making those EV stations, I'm sure.
Yeah, right. See, episode, what was that, like 2?
Yeah.
I think we covered that. The other kind of thing here is you can just see the fact that private services is just so much bigger just by weight than the other ones. You can kind of just see that by where this falls. I mean, imagine if private goods, this massive growth was sort of the same size as the private services, then you'd expect this number to be like up here or something. So, and they you can break this down. You can get these numbers, but again, 3% growth seems doable.
Yeah, I mean, certainly looking at this chart, it doesn't seem outlandish. I guess the other thing that I'll say is that, like, over the past, like, post financial crisis period, like past 15 years now, it's like the mainstream, or it's like agreed upon in mainstream economics that for all these reasons, the U.S. will be transitioning into like a structurally slower growing economy, and then like some of the major ones are demographics, the birth rates going down, people are aging, they're going to be working less on net, and then productivity growth as well has really stagnated quite a bit over the past decade. Now, this decade with AI, maybe that changes, but that's a different topic. But that's all just to say that the economic mainstream, the Fed, and take your pick of whatever Harvard economist or whoever, it's generally agreed. Like, everyone says, like 2% is like the long-term U.S. growth potential, and they think it's like very difficult to sustainably get above 2%. So whenever you hear this criticized, that's typically where this is going to be coming from. People are looking at this and thinking, 2 and 3, but on a relative basis, 50% higher. So that's why this is kind of a goal for him. It's like looking at this chart, it's like, oh, we're already there, it kind of looks like. But he's kind of fighting against the long-term 2% growth.
Yeah, no, that's good context. And you'll see later when people gave him a lot of flack, I think you'll see that get cited as well. I'll show you. I'll show you that in a bit. The other thing I'd just point out here, just as a note, is the graphic does not break out net exports or investments, so we don't really see where that comes. Although I imagine it's relatively de minimis, certainly the exports. But imports have increased, which is a drag on GDP. And one of the things in the notes in this report, it said that business investment had increased, which is also a boon to GDP. Now let's talk about the 3% deficit. Now this is one that I'm personally sort of most excited about. I think it's the most important. And what we're looking at here, the Congressional Budget Office will put together a report like this, and it's very good. There's link in the description. And you can see just some of the high level numbers. So we got receipts. So this is income for the government. These are your taxes, basically. The bulk of this is going to be your income tax. and then we have outlays, and then we have the delta, and then it provides us the percentage of gross domestic product, this number as a percent of GDP. So right now we're sitting at a deficit as a percent of GDP at minus 6.4. That's for last year, 2024. I think it's grown since. And what I wanted to do was, you can kind of look at this. It's a little bit harder to see, okay, is 3% reasonable or not? But you can sort of play with some numbers. And that's what I wanted to show. That's what I wanted to share with you. All right. So you'll recognize these numbers. We were just looking at them for 2024. So this is what I just took. I calculated out what the GDP was just based upon that minus 6.4 number. So you'll see that they called it, this deficit was 6.4% of GDP. So I just calculated it. I just backed into that number. I grabbed receipts, same number. Receipts as percent of GDP. That's just going to be the receipts divided by GDP. Same thing with outlays. I think you get it. Yeah. And now we can just project this out over the next for the next 4 years. Now up here are my inputs. So we got the growth. We can put in whatever we want, and this is going to be growth to GDP. So it's going to impact this number. Our target deficit. So he wants to target a deficit of 3% as a percentage of GDP. And another thing that I thought we might be able to play with are the receipts as a percentage of GDP. And even before I get to that one, let me make a quick point. So this is kind of interesting, and it's sort of been theorized that just almost physically, the amount that you can just draw out of the economy in terms of taxes is like 20%. Or it's something closer to like something between 15 and 20%. And you can just see this right here. These are the revenues. So this is sort of how much is being, let's call it, extracted from its citizenry in the terms of taxes. Over the last several decades, you just can't seem to get that number above, call it 17, 18% consistently, right?
Also kind of interesting, it kind of spiked in 2009 a little bit.
Oh, so the blue is outlays. Now, outlays, you can spend as much as you want. So you can imagine, it's spiking after, the government wants to spend a whole bunch of stuff after crises. So
right, but what happens. So that's where the outlays increased over that crisis. But you also see COVID. Like over the COVID period, you don't see the revenues budge at all. Like, in fact, they
would dip, which you would kind of expect when a bunch of businesses are contracting, people are getting laid off. You'd expect it to dip. So just kind of keep that in the back of your mind when we play around with some of these numbers. But let's look at it. What he wants to do is to get growth at 3%. He wants to get a target deficit of 3%. And let's just keep the receipts as a percent of GDP constant. Now, what you can do is what we're looking at here are the outlays. Like, what do we need by 2028? We need to get these outlays down from 6.7 trillion down to about 6.5 trillion. And the thing is, like, it's not a mistake that he chose kind of the 3% number for growth and the 3% for the deficit, because that's considered to be sustainable, because that means that your total overall debt to GDP ratio isn't going to increase. It's just going to stay constant. So I didn't talk to him personally, but I don't think that was an accident that those two numbers are the same.
We'll have to get him on the phone after this.
Yeah, I'll call him up. In fact, let me just text him real quick.
Yeah. Quick commercial break.
But you can see that in order to do this under these scenarios, you don't really need to cut a whole lot. So we're talking like, over the next 250 billion total over the next 4 years. And that's not a lot. But again, that's growing at 3%. That's a pretty fast growth rate. What if we said we didn't grow at all? right? Now all of a sudden you got to cut a whole bunch more. You have to, it's like 4 times that amount you need to cut.
Mm-hmm.
What I think a lot of, when this is kind of more from the right, when they're trying to sell like tax cuts, for instance, one of the arguments that they might make is say, look, we're going to cut a bunch of taxes. That's going to grow the economy, and we're just going to grow ourselves out of the budget deficit.
Mm-hmm.
Like theoretically, I can just show you that that's like possible. So you can imagine if we grew at like 6%, in that case, we can actually increase the amount that we spend each year,
Mm-hmm.
and we can still hit the 3% target deficit. Right.
Right. And then that's the same idea we briefly mentioned, that a dollar of private investment is going to be more productive than a dollar of government spending.
Right. So when people like when people say they're going to grow out of the debt, this is kind of what they're talking about. Something like
Mm-hmm.
this. Now, this is what
And
I
then
want to
it's
see.
like, sorry, not to go on too much of a tangent, but that in mind, one of our previous episodes talking about the UK, that's their big problem at the moment, is that their growth is coming out to be a lot smaller. I think they estimated 2.5%, but their latest prints, I think, have been like right around zero.
Yeah. That's a problem, because then all of a sudden what used to be a sustainable deficit is no longer sustainable,
Mm-hmm.
which is why I don't even really like why you're targeting 3%. I say just go straight to, just
Yeah, and like
balance it.
that's the other funny thing is like, oh, we got it down to only 3%, but that means your total debt is still growing every year
Yeah,
nonstop.
exactly. I want to go down to like, 0. Can you balance
Mm-hmm.
the budget, please?
Right.
And if you grew at something a little more modest, let's call it 2%, then it's like how much you need to cut over the next 4 years. And now we're looking at some like pretty serious numbers. You need to cut 1.4, call it 1.5 trillion total from the budget over the next 4 years. Most of the time when
Right.
people are
That's like
quoting these
25%
numbers,
of all outlays.
yeah, we can, I can show you sort of what those outlays are. And sort of the next question is, and what I kind of writ down here is like, is that even possible? Like, do we even have that much we can cut?
Well, I mean, Elon said he's going to cut 2 trillion, right?
Right. Over the next, I think that's what I'm saying. I mean, usually they speak in terms of like 10 years, I think. I don't think he doesn't, I don't think he means every year.
It's
I,
yeah, not probably not. I mean, who knows with Elon, but yeah, typically whenever people will cite these numbers, they're doing the same thing
they're talking about 10
we're
years.
doing here. Yeah.
I would think, and maybe that's a little misleading because you should, I think, speak about this in terms of every year, but whatever. The other thing is,
It
you can
sounds
also,
better.
you can also play around. Like if you were able to successfully raise taxes, then it, becomes a little easier. If we went up to 20%, but ideally we would get this number down. So now, you're looking at these kind of numbers. You have to cut 500 billion from the budget per year over the next 4 years. But the next thing, so you kind of got all that, right? I think this is a really handy tool just to kind of illustrate those points. You can grow yourself. You can grow out of a budget deficit. You don't need to cut spending. You just got to grow a whole lot and keep spending somewhat constant. And let's go look at just kind of some numbers that we could even cut. So we had some earlier numbers. We were talking about, maybe 250 billion or something per year. These are the total outlays. So we have the largest mandatory spending programs right now, as of the full year 2024, are coming in at like a cool 3 trillion. Most of those we talked about: Social Security, Medicare, Medicaid. And down here is a little bit more discretionary, although for whatever reason they put like interest. You can't skip out on the interest payments, and that's almost 1 trillion. I think it's like breached the trillion recently, so that's not on the table. You can't really cut that. Department of Defense. All of a sudden now you're trying to find like 500 billion from here, and it becomes a lot harder. You're blowing out whole departments almost. So that's sort of the problem that they're facing now. I think the 3%, if he's targeting this, let's just keep it 2% for a second, and let's go back to 17.2. We'll just keep that the same. We'll assume they don't raise taxes, although they're probably talking about lowering taxes. So maybe it makes sense to go to like this or whatever it is. You got to cut 138 roughly. These are just rough numbers, obviously. Billion every year from the budget. That seems doable. That doesn't seem totally crazy.
Yeah, and then like
again, this is what
cutting
I want.
138 every year is the same as like if you were theoretically just to take out some department and then keep it out.
Yeah,
that's what you would you would maintain those savings presumably throughout the following years if you don't increase.
Didn't they say? Wasn't there just recently? We'll give you a whole bunch of severance pay if you just quit right now, and that was supposed to save like 100 billion. I mean, you're almost you're making some serious headway into these numbers, even if you just got rid of, you get a hiring fees, plus you got rid of a pretty good chunk of the salaries.
Yeah, so definitely. It's like I forget the exact number, but I want to say like 3.2 million federal employees currently, not counting the postal service, which is like another huge number.
And again, just really rough estimates here. You're making some good headway, which I didn't really appreciate. I thought 100 billion or whatever, it's not going to do anything. But when you combine it with the growth rates,
right,
and if you can keep,
you can start to narrow the deficit
if you can keep, another big assumption here is that you're keeping the tax income the same.
And so that's actually one of the biggest issues that Bessent's going to have to deal with first. The Trump tax cuts from his first term are set to expire this year. And all of these congressional budget projections, they all assume that they're not going to be extended. When in reality, it's like even if Biden was in office, everyone kind of knew in reality they were going to be extended. But that's another, like, I forget what the number is, but it's a very huge chunk. And then I think during his confirmation hearing, obviously he was talking about that quite a bit. I think he was saying on average it would result in everyday people paying like up to an additional $800 a month out of your pocket in increased taxes. That's painful.
You're talking about if you did not keep the Biden tax.
I'm sorry,
the Trump tax cut. Sorry.
Mm-hmm.
Yeah, that's painful. That's a lot.
Yeah, so he's been saying that's his number one concern coming into this role, and it's going to have to be resolved soon. But no one really knows how yet.
But kind of after looking at all that, we can sort of look at some of the narratives that have been bouncing around on the left here. We got bounce around X, we got Yahoo Finance. So one of the things you might hear, and I've seen this a couple places, is that the 333 plan will turn out to be more like a 260 plan. So 2% growth. So that's a nod towards what you'd said earlier, being kind of the long run growth of the U.S. is going to be 2%. 6, they think they can get the budget deficit down to 6, down from like 7 to 6. And then 0, they don't think they're going to increase.
We're like right around 6 today anyway.
Yeah, so a big fat nothing. And again, I don't know.
Change the deficit effectively. No change to oil production. Like he doesn't.
I don't know.
I mean, long term. That's just him saying this is what the mainstream thinks.
Right. Or just general, whatever it is.
But I mean, you continue what we've got going at the moment, and change nothing, and that is probably what you would get.
Yeah. So I mean, you and I are both looking at the same numbers here. 333 doesn't seem to me to be totally crazy. And then this guy, rising interest burden on rapidly increasing blah 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 will make 3% real GDP growth highly unlikely. I don't know where he's coming at from. Is he attacking the real GDP number? But that's sort of a nod towards inflation.
He's citing the national debt, and he's right. Mm-hmm. The inflation or the interest on that debt is really high.
Mm-hmm.
That kind of is, but if that's, I don't see the direct connection.
Yeah, I don't see the connection here.
I don't. It's like you can spend more as the government, and it's going to go up. But presumably, you're going to get some sort of GDP growth
Right.
out of that. So
right. He's
I
taken
think
a
it's under the
couple.
assumption if you raise taxes or some of these other things to try to narrow the budget, then you're going to take a hit to GDP growth. But
The only connection I can make is like the interest burden. So the amount of paying is going to be such an incredible drag on GDP overall that they can't make 3%, which I don't. Which doesn't as though we're hitting 3% now and we're paying $1 trillion. I just don't. There's a couple steps here. He'd need to elaborate on what the connection is. This one, the current federal budget deficit, reducing to 3% will require over $1 trillion in annual spending cuts. That will never happen. I mean, I just showed you earlier. It's not $1 trillion. It really depends a lot on what the growth rates are, and if we can keep sort of the inflows, the inlays, the tax revenue where it is. You don't need $1 trillion. And again, it's annual spending cuts. So you can't really hide behind around this like 10-year thing. I don't know. So this seems a little too much. And then it does third, increasing the already high oil production. I guess it is record high. I mean, just based on the graph that we saw, not by much. I mean, we sort of got back to 2020 numbers. And then by the over 20%, yeah, close enough. Would not be easy. I don't know. I mean, we know that. I think we know that we haven't shown you this, but you can see graphs that it's like in the ground. So, and if it does take several years to come to fruition, well, that's fine. We have several years. So I don't know. 333 doesn't seem so crazy to me. All right, man. Well, that's all I had to say. I hope you found it informative.
It's going to be fun to watch.
We'll see if he does it. I mean, I hope so. Frankly, I think it's not ambitious enough. I would go for I want 0%. Just get a balanced budget, man.
333.
I can't believe it's so hard.
How about like 4010? How about that?
Yeah, 4010.
All right.
That's what I'm talking about.
He said drill, baby, drill. Like, come on.
I know, seriously. It's just kind of continuing. You just sort of draw the same line that was already there. I want like it just straight up. Well, whatever. I mean.
Yeah.
All right. Well, thanks for clicking the link. See you next time, which might be very quick. All right.
See ya.
Later. Bye.